Oil just flashed a signal I've seen twice in my career, and both times a violent reversal followed. Brent at 86.46, WTI at 81.81. 3 days of selling. Iran-Oman. Hormuz talks are spooking the market, but EIA just reported inventory builds way below expectations. I just mapped out the exact levels. $85 on Brent is the line. Break it and we flush to 82. Hold it and we rip back to 90. Full breakdown with exact scalps and swing levels on the main channel. Don't trade this without watching. First, let me take you back to June 2026. Brent crude had just collapsed from above 1,202.72 in a matter of weeks. The market was pricing a full resolution of the Hormuz crisis. Everyone thought the geopolitical premium was gone, and then it was NT. The ceasefire broke down, tankers started getting hit again, and oil ripped higher by nearly 30% off that June low. I'm seeing echoes of that same setup right now. Brent crude is trading at 86.46 a barrel. WTI is at 81. We've had 3 consecutive days of selling. The market is pricing in hope that Iran and Oman will reach a deal to reopen the Strait of Hormuz. But here's the thing I've learned in 2 decades of trading this market. Hope is the most expensive commodity in oil. The last time we saw this kind of aggressive risk premium unwind, it was June, and the market got absolutely blindsided when the deal fell apart. I'm not saying that's going to happen again, but I'm saying that the risk-reward at these levels is starting to look very interesting. Here's the promise I'm making you in this video. I am going to break down exactly what's driving this 3-day sell-off. I'm going to show you the technical levels that matter, where the real support is, where the resistance lies, and what would invalidate the entire setup. And I am going to give you 2 scalps and 1 swing trade with exact entry levels, stops, and profit targets. If you're long oil, you need to watch this. If you're short, you also need to watch this, because this market is about to make a decision, and it's happening fast. Here is my weekly verdict, plain and simple. Oil is at a critical inflection point. Brent has fallen from last week's highs above 94 to current levels around 86.5. WTI has dropped from above 87 to below 82. That's a roughly 8% decline in about a week. The bias is neutral to bearish in the very short term, but that bearishness is getting stretched. My invalidation level for the bear case on Brent is a daily close below 85.0. If we lose that, the flush to 82 becomes the base case. For WTI, the key level is 80.00 break. That, and we could see 78 or lower. On the upside, Brent needs to reclaim 89.00 to shift the short-term bias back to bullish. For WTI, that level is $84.0. But here is what I want you to understand. This is not a market where you can just pick a direction and hold. This is a market where you need to trade the levels with precision, because the volatility is high and the catalysts are binary. The setup I'm seeing right now is the kind of setup that separates professional traders from everyone else, and I'm going to show you exactly how I'm playing it. Before we get into the technicals, drop a comment below. Are you buying this dip or waiting for lower prices? I want to see where the sentiment is. Let's start with the weekly chart, because this is where the big picture lives. Oil had a massive run from the June lows. Brent recovered about 24% from 72 to above 94. And WTI recovered about 18% from 69.58 to above 87. That saw a significant rally off the war low base, but the weekly momentum has rolled over in the last 2 weeks. The weekly RSI is coming off overbought territory, and we're seeing what looks like a classic pullback within a broader uptrend. Now let's zoom into the daily chart, because this is where the real action is. Brent crude closed at $87.84 on August 26th, down 0.74 or 0.84 on the session. The intraday low was even lower. Brent briefly dipped to levels not seen since August 17th. WTI closed at 82.23, down just 0.13 or 0.16%. But here's the key: WTI had traded as low as the high 79 range during the European session before buyers stepped in. That intraday reversal is important. Both benchmarks recovered most of their session losses after the EIA data came out. The EIA reported that U.S. crude inventories rose by only 95,000 barrels for the week ending August 21st, bringing total inventories to 428.9 million barrels. That massive lie undershot the consensus estimate of a 597,000 barrel build. What that tells me is that the physical market is tighter than the headline fear suggests. The market had been pricing a much larger build, and when the number came in lean, the selling pressure eased. Let me show you what this looks like on the charts. On the daily chart, Brent is now testing a major support zone. The 85-87 area has been significant in recent months. It's the zone where oil found buyers after the June collapse and again in early August. The 200-day moving average is somewhere in this neighborhood, and a break below it would be technically significant. The RSI on Brent has dropped sharply from overbought levels. It's now approaching oversold territory, which suggests the downside momentum is getting exhausted. But I've seen this before. RSI can stay oversold for extended periods in a strong downtrend, so I'm not relying on that alone. The MACD on Brent has crossed bearish and the histogram is expanding lower. That tells me the bearish momentum is still intact in the short term. What I'm watching for is a divergence. If price makes a lower low but the MACD histogram fails to make a new low, that's a signal that the selling is losing steam. Now let's look at WTI on the daily chart. WTI is trading at $81.81, just above the 82 support level that has been tested multiple times. The 5-hour chart shows WTI pinned below its 20-period average with bearish momentum building. The benchmark is clinging to support and has slid beneath its short-term averages. The RSI on WTI has dropped to the high 20 seconds on some intraday readings that steeply oversold territory. The last time we saw RSI this low on WTI, we got a sharp bounce. But again, oversold doesn't mean buy. It means the selling has been aggressive. What stands out to me is the spread between Brent and WTI. Brent is trading at roughly a 4.65 premium to WTI. That's within the normal range, but it's worth watching. If the premium starts to widen, it suggests supply concerns are more acute globally than in the US. If it narrows, it suggests the market is pricing in a global supply recovery. Let me zoom into the 4-hour chart because this is where the near-term structure becomes clear. On the 4-hour chart, both Brent and WTI are in what I call a falling knife pattern, steep declines with occasional bounces that get sold. The 4-hour chart shows lower highs and lower lows, which is the definition of a short-term downtrend. The 20-period EMA on the 4-hour chart has been acting as dynamic resistance. Every time price rallies to that level, sellers step in until we see a clean break above that EMA with volume. The short-term bias remains bearish. The 1-hour chart is even more instructive. We're seeing a potential double bottom pattern forming near the lows, but the confirmation requires a break above the neckline for Brent. That's around $88. For WTI, around $83. Without that break, The 1-hour chart remains in consolidation mode, and consolidation in a down trend usually resolves lower. One thing I'm watching closely is the volume. Selling volume has been heavy, but the recovery off the lows on Wednesday was on lighter volume. That tells me the selling pressure is abating, but there's not yet aggressive buying coming in. That's a classic pattern. The market is waiting for a catalyst. Now let me walk you through what's actually driving this market, because the fundamentals are where the real story lives. First, the Hormuz negotiations. This is the single most important factor in oil right now. Iran and Oman have announced that they've reached a basic framework agreement on opening temporary shipping lanes and clearing mines in the Strait of Hormuz. The market has interpreted this as a significant step toward reopening the strait, which would restore the flow of roughly 1/5 of global oil consumption. But here's my personal take. I've seen these diplomatic headlines before. The market gets excited, prices drop, and then the reality sets in that the details are far from settled. Pakistan's army chief just concluded a visit to Tehran, and Oman's foreign minister is separately traveling to Iran. These are positive signals, but they're not a done deal. Saxo Bank's head of commodity strategy, Ole Hansen, put it well when he said that if a credible agreement is reached and Hormuz traffic is quickly restored, the geopolitical risk premium could shrink further. But that if is doing a lot of work. The market is currently pricing in a significant probability of a deal. That's why we've seen this aggressive sell-off. But if the talks stall or collapse, the risk premium will snap back just as fast as it unwound. Second, the demand picture. This is where things get complicated. The IEA, EIA, and OPEC are fundamentally divided on where oil demand is heading. The IEA has taken the most bearish stance. In its August report, the agency forecast that global oil demand would decline by 1.6 million barrels per day in 2026, a downgrade of 510,000 barrels per day from its previous estimate. The IEA cited high prices suppressing consumption, weak manufacturing in Europe and the U.S., lackluster demand from China, and the end of the summer driving season. OPEC, by contrast, is much more optimistic. The cartel sees a resilient global economy and forecasts oil demand growth of 0.6 million barrels per day in 2026, accelerating to around 2 million barrels per day in 2027. OPEC points to India, China, and other emerging Asian economies as the key drivers of demand growth. The EIA is somewhere in the middle. The agency raised its Brent price outlook for 2026 to 87 per barrel, up $5 from a month ago, citing Hormuz shipping constraints. But the EIA also acknowledged that U.S. crude inventories are expected to decline, with year-end inventory forecasts cut to 396 million barrels, a reduction of nearly 9%. What stands out to me is not the headline forecasts, but the divergence between the agencies. When the IEA and OPEC disagree this dramatically, it tells me the market is genuinely uncertain about the demand outlook, and uncertainty usually means volatility. Third, the inventory picture. The EIA data from Wednesday was the most important piece of hard data we've gotten all week. U.S. crude inventories rose by only 95,000 barrels, massively undershooting the 597,000 barrel consensus. That's a bullish signal in a bearish tape. Gasoline and distillate inventories also showed tighter than expected conditions. But here's what I'm watching: the broader supply picture. U.S. production remains at elevated levels. Non-OPEC producers are increasing output, and OPEC Plus has already agreed to raise production quotas by 188,000 barrels per day starting in September. The global supply picture is generally loose, with the major exception of the Middle East disruptions. Russian energy facilities continue to be targeted by Ukrainian attacks, which is keeping some supply risk priced into the market, and the West's decision to suspend all financial and economic transactions with Iran has refocused attention on the fraught ties between major Gulf producers and Iran. Fourth, the calendar ahead. The next 48 hours are relatively light on scheduled data, but the geopolitical calendar is what matters most. Any headlines out of the Iran-Oman talks will move this market sharply. What I'm watching is not just the headline news. I am watching the term structure of the futures curve. If the front-month contracts continue to trade at a discount to future months that's contango, it suggests the market is well supplied in the near term. If we see the curve flip to backwardation, with front-month prices higher than future months, that's a sign of physical tightness. Now let me give you the 3 trades I'm watching. These are the exact levels I am using in my own trading. Scalp setup 1. Brent the oversold bounce. This is a high probability scalp for the next 24 hours. Trading the oversold bounce off the 85-86 support zone. Entry zone 85.50 to $86.0 stop loss. $84.5 take profit 1, $88.0. Take profit 2, $89.50 risk reward. Approximately 1 to 1.5 to 1 to 3. Invalidation, daily close below $85.0. The rationale here is simple. Brent has dropped nearly 8% from last week's highs. The RSI is approaching oversold territory. The 85-86 zone has been a significant support level in recent months, and the EIA data suggests the physical market is tighter than the headline fear suggests. What I like about this setup is the risk reward. We have a tight stop below the key support level, and the upside targets are clearly defined by the overhead resistance levels. This is a classic mean reversion trade. Scalp setup 2, UD the resistance fade. This is a counter-trend scalp for the next 24 hours, trading the potential failure at resistance if the bullish catalyst fails to materialize. Entry zone 83.00 to $83.5 stop loss. $84.5. Take profit 1, $81.0. Take profit 2, $79.5. Risk reward, approximately 1 to 1.3 to 1 to 2.6. Invalidation, daily close above $84.0. If the Hormuz talks continue to progress or the market fails to get a new bullish catalyst, WTI could reject the 83.80 for resistance zone and resume its downtrend. The 4-hour chart has been making lower highs and lower lows, and a failure at resistance would confirm the continuation of that short-term downtrend. Here is my thinking on this trade. If we get a spike up to 83.5 on the open and the volume isn't there to support it, that's a fade. The market has been selling off for a reason. There's no conviction on the upside yet. A rejection at resistance with a bearish divergence on the 4-hour RSI would be the trigger I'm looking for. Swing setup. Brent the 48-hour structural breakout. This is the swing trade that captures the structural move over the next 48 hours, playing the potential for a sharp reversal if the Hormuz talks disappoint. Entry zone 85.00 to 85.50 on a confirmed break below support. Stop loss $87.0. Take profit 1, $82.0. Take profit 2, $79.50. Risk reward, approximately 1 to 1.5 to 1 to 2.5. Invalidation, daily close above $87.0. If Brent breaks below 85.0 with conviction, the next target is $82.0, and then 79.5. The catalyst could be a break through in Hormuz negotiations that signals a rapid return of supply. Either way, the breakdown trade offers excellent risk Reward if the support level gives way. What I'm looking for is a clean break, not a spike, and recover aerial break with sustained selling, pressure and volume confirmation. The bearish momentum is already building, and a break below key support could accelerate the move lower. Here is the key insight I want you to take away. The swing trade is directional. You betting on a structural move. The scalps are about playing the volatility around the news. In this market, you need to be ready for both. Before I wrap this up, I need to talk about risk management because this is where most traders get it wrong. I've been trading oil for 20 years, and I can tell you that oil is one of the most volatile markets you can trade. I've seen 5 moves in a single session. I've seen the market gap 10 overnight on a geopolitical headline. If you're not managing your risk properly in this market, you will get wiped out. Here is my personal rule. On any single oil trade, I risk no more than 1% of my account. On the swing trade, I might risk 1.5% if the setup is truly exceptional. But that's it. The reason is simple: oil volatility can blow through stops faster than you can react. You need to give your trades room to breathe, but you also need to protect your capital. The other rule I live by is this: if I'm not sure about the trade, I don't take it. There's always another setup tomorrow. FOMO is the enemy of profitability. I learned that lesson the hard way in 2020 when oil went negative. Yes, negative, and I've never forgotten it. For these oil trades, here is my risk assessment. The scalp trades are lower probability but higher frequency. You playing the volatility around news events. The swing trade is higher probability but requires patience. Size accordingly. If you taking all 3 trades, your total account exposure should not exceed 2.5%. And remember, these are my levels based on my analysis. You need to adjust them based on your own risk tolerance and account size. Don't blindly follow anyone's levels. Use them as a framework and make them your own. So let me summarize what we covered today. Brent crude is at $86.46. WTI is at 81.81. We've had 3 consecutive days of selling, driven by hopes of a Hormuz breakthrough between Iran and Oman. But the EIA data tells a different story. Inventories are tighter than expected, and the physical market is not as loose as the price action suggests. The key level to watch on Brent is 85.0. Below that, bears have appeth to 82 and 79.5. Above 89.0, the bulls take control and we could see RN back toward 94. On WTI, the key level is 80.0. Break that and we could see 78 or lower. Above 84.0, the short-term bias shifts back to bullish. I've given you 2 scalps and 1 swing trade with exact levels. The Brent oversold bounce at 85, 50, 86.0. The WTI resistance fade at 83.00, $83.5. And the Brent swing break down below 85.0. Here is what I want you to do. Watch the Hormuz headlines close lie. That's what's going to move this market. Trade the levels I've laid out, but always respect your stops. And if you found this analysis useful, drop a like and subscribe to Trade Meridian Decoded. Trade smart, manage your risk, and I'll see you in the next one.